Guinness is entering a new golden age. In fact, the beer brand is now the UK and Ireland's #1 best-selling beer. Guinness has found new consumers through women and young drinkers. There's even a new internet persona called the Ginfluencer helping fuel this growth. I love Guinness. In fact, I love Guinness so much that I can't sit here and talk about it without pouring a glass. It's 11:30 in the morning, so I'm drinking their non-alcoholic version. But did you know that this NA version is one of the best NA brands in the world? It's growing like wildfire. Sales were up 50% last year alone. Not bad for a 265-year-old company. Although we can't invest directly in Guinness, right now at least, since it's owned by London-based conglomerate Diageo, we can take a look at Diageo and see if there's opportunity there, since Guinness is one of their flagship brands. Let's dive in. The stock price is down about 25% over the past year, and their PE ratio is about 13 right now, and they pay almost a 4% dividend. They have companies like Zacapa, Don Julio, Casamigos, Guinness of course, Bailey's, Johnny Walker, Captain Morgan, Smirnoff, etc. They currently have 4.7% of the entire global alcohol market. Diageo makes money by handling all stages of product life, from sourcing raw materials to the manufacturing and distribution of their final products. They call it a grain-to-glass model, and I love that. It's great to see a company have that much vertical integration. They say many times in their annual report that they use a data-first approach when designing new products or trying to build their brand. And another thing that's really cool about their business model is they've broken it apart by geographic segment. And they break up each geographic segment into its own little business, where each geo market is accountable for its own growth and performance inside of that market. I think that's a really great idea and is a great way to show global growth, because there's a huge difference between the companies who say they're going to play on a global level and actually do play on a global level. So given their global distribution network and their amazing brands, this does look like a moat. It'll be later on in our research process that we actually evaluate for a moat, but I do like the sense that I'm already seeing one. This all goes to say, this is exactly what we would expect from a key player in this industry. It's a $70 billion company, so we do expect these moats to be in place. So that covers the first step on how the business makes money. The second thing we want to look at is the business growing? And it's a little bit of a mixed bag here. Sales were up 10% last year, and they've grown at about 12% over a 5-year period, while net operating cash flow is down 23% this year. And net income did grow 14%, but there's something really interesting about it I found while reading their annual report. Under operating profit, their numbers were almost flat. They grew by 200 million. So if we go to their income statement in the annual report itself, we can see that operating profit grew modestly at about 200 million pounds. However, if you go into their annual report and pull up their physical income statement, you can see that Guinness kind of saved their ass. Here's how. If we look at their operating profit, that only grew about 5%, from 4.4 billion to 4.6 billion last year. And if you look at these line items, you can see there's a big thing that sticks out between 2022 and 2023, and that's the non-operating items. And if we go to the footnote, we can see that the non-operating items changed drastically, and they say that it's mainly driven by the sale of Guinness Cameroon, which is the Cameron Island segment of Guinness. And so because they sold a part of Guinness off, that allowed them to report profits increasing by 14%. It's a pretty good move, but that's a one-time event, so it doesn't make me want to buy Diageo more, but it does give me the sense that they might be interested in spinning off Guinness, which I would love to buy. I love that company, and I love to invest in what I know. For now, let's just focus on Diageo and see if there's something there, because it is an interesting company in their own right. And like I said before, their PE ratio is trading at historic low levels, and they're paying a healthy dividend with a really impressive share buyback program. So the business does seem to care about shareholders, despite the stock being down so much. Before we get into the alcohol market, understanding the industry is very important too. There's a huge megatrend that we have to be aware of, and that's that Gen Z is drinking less than millennials, and millennials are drinking less than Gen X or boomers. Overall, the globe is drinking less and less, especially as more and more data supports that there really is nothing good about alcohol. But it seems like the company is pivoting well. We mentioned the 50% growth of Guinness Zero. They also have Tanqueray Zero that's selling really, really well, and other non-alcoholic brands. So I like that the company can get in front of this. They say directly in the annual report that they believe that premiumization goes hand in hand with moderation, And that's an interesting idea. They basically say that as people are drinking less and less, they're drinking nicer alcohols. Diageo seems to be trying to position itself as the LVMH of alcohol. If you're not familiar with LVMH, they're basically the luxury apparel company of the world. I wish I would have invested in LVMH years ago. They own companies like Tiffany & Co., Dior, Louis Vuitton, Tag, Fenty, Sephora, and some wine and alcohol companies in their own right. And their stock has performed really well. It's up about 900% since they IPO'd back in 2008. Their CEO, Bernard Arnault, is one of the richest people in the world. And his idea for LVMH started in the 1980s. He basically had the idea that a luxury brand on its own would have a lot of turbulence as the brand fell in and out of favor. But if you could create a conglomerate of luxury brands, as one brand was building their identity, the other ones in the portfolio could cover it, creating predictable cash flows, which is something investors really, really like. And it's worked out pretty well. The stock is up 980% since the company IPO'd in 2008, and Bernard Arnault is one of the richest men in the world. We've covered how the business makes money and is it growing. Now let's look at how we'll make more money in the future. The company's very clear about how they want to grow. They have this long-term goal of going from 4% of the total alcohol market to 6%, which would represent a 50% growth in their sales. That's ambitious, but that doesn't get me super excited. I like it when a CEO has a big, ambitious goal. They just got a new CEO, Deborah Crew, and so maybe she'll have a little bit more ambition in building this brand. I would love to see them take an LVMH approach, but I have to see strong messaging on that. Bernard Arnault was so obsessed with creating this luxury image. He is notorious for being a total micromanager and showing up at storefronts and critiquing every little part of the business. It's how these world-class luxury brands are built. So perhaps Miss Crew can do it. Time will tell. And right now, because I don't know much about the global alcohol market, I'm not seeing a big ambitious goal. I'm waiting. I'm neutral on the company. I'm neither bearish or bullish. Hopefully, since they wet their beak in selling a piece of Guinness off with the sale of Guinness Cameroon, hopefully they're interested in selling off the whole caboodle. I would love to see Guinness stand on its own. Warren Buffett invested in Coca-Cola because he believed that 300 years from now, people will still be drinking Coca-Cola. The founder of Guinness, Arthur Guinness, signed a 9,000-year lease at their St. James brewery. And so I would venture to guess, and I would put my money on this, that people will still be drinking Guinness 300 years from now. And those are the type of enduring companies we love to see. That's all for this episode. If you enjoyed this content, please consider giving us a like and subscribe. We believe that the current ecosystem of investing is messed up on the internet. There's way too much day trading, which historically most day traders lose money, and there's not enough talk about buying and holding businesses in a Buffett-style long-term fundamental approach. So your like and subscribe will help us get this out to more people. And if you really, really liked the content, please consider joining our Patreon, where you'll get early access to our Flank platform, which will walk you through step by step exactly how to research your first company. Thanks so much, and we'll see you next time.